You paid the IRS more than you owed last year. Not because you cheated yourself out of some exotic loophole, because you never wrote down the mileage. The IRS set the standard mileage rate at 72.5 cents a mile for 2026 per Notice 2610. So, a freelancer who drives 6,000 business miles and logs none of it hands back $4,350 of deductions. At a 22% federal bracket plus 15.3% self-employment tax on that income, that's roughly $1,600 in real cash. Gone. And mileage is the easy one, the deduction that's sitting right there in your phone's location history. So why does almost every 1099 worker I talk to have a Schedule C that's missing 4 or 5 lines that legally belong to them? Let's start where the confusion actually lives, which is that phrase everybody says at dinner, "I'll just write it off." That phrase is the most misunderstood sentence in freelancing, and it's costing you 2 ways at once. A write-off is not a rebate. If you're in the 22% bracket and you buy a $2,000 laptop, you don't save $2,000. You save $440 in income tax, plus roughly $283 in self-employment tax if it comes off your net profit. Call it $723 total. You still spent $2,000. Buying junk in December to save on taxes is just spending money faster. But the flip side is where the real damage happens, and it's the direction nobody talks about. People say write it off about the fun stuff and then skip the boring, completely legitimate deductions because they're not sure they qualify. The actual standard is written in Section 162 of the tax code. Ordinary and necessary for your trade or business. Ordinary means common in your line of work. Necessary means helpful and appropriate. That's a wide door. Your Adobe subscription walks through it. Your Zoom license, your accountant's fee, your business bank account fees, the $30 domain renewal you forgot about, all of it. And what counts as ordinary in your specific line of work genuinely differs. A photographer's camera body is obvious. A copywriter's is a harder argument. My take: if you can explain the business purpose out loud in one sentence without wincing, deduct it and keep the receipt. Now the vehicle question, because it's the biggest number for most people who drive. You've got 2 roads. Standard mileage at 72.5 cents for 2026. That rate already includes gas, insurance, repairs, and depreciation, so you don't get to stack those on top. Or actual expenses, where you total everything the car costs you and multiply by your business use percentage. Here's what I'd do. If you drive a paid-off Corolla a lot of miles, take the mileage rate. If you're driving something expensive with heavy depreciation and fewer miles, run the actual expense math. One catch that bites people: if you want the option to switch methods later, you generally have to use standard mileage the first year the car's in service. Also, and this one's non-negotiable, your commute isn't deductible. Client to client is. Home office to client is, which is one of several reasons the home office deduction is worth taking. Track it with an app, MileIQ, Everlance, whatever. I'd rather you use a bad app than a good memory because reconstructing a year of driving in April is a nightmare I've personally lived through. Which brings us to the home office, and I'll be blunt. Stop being scared of it. The audit bait myth is decades old, and it does not match how the IRS actually operates now. IRS data shows the audit rate on individual returns has been running around 0.4% or lower in recent years. The rules live in Section 280A. You need a space used regularly and exclusively for business, and it has to be your principal place of business. Exclusively means the corner of the guest room where the desk is, not the dining table where your kid eats cereal. The simplified method gives you $5 per square foot up to 300 square feet, so $1,500 max. The regular method takes your office square footage as a percentage of the home and applies it to rent or mortgage interest, utilities, insurance, and repairs. If you rent a $2,400 a month apartment and your office is 12% of it, that's $288 a month, $3,456 a year, more than double the simplified cap. Run both. Take the bigger one. Renters in expensive cities almost always win with the regular method. If you own a small paid-off house, the simplified method might genuinely beat it. So do the arithmetic instead of guessing. Here's the part that trips up people who've been freelancing for years. Some of the best deductions aren't on Schedule C at all. Self-employed health insurance premiums come off on Schedule 1 as an adjustment to income, which means you get them even if you take the standard deduction. And for 2026, that standard deduction is $16,100 for a single filer per IRS Revenue Procedure 2025-32. So most freelancers are not itemizing. Retirement contributions work the same way. A solo 401k lets you defer up to $24,500 as the employee for 2026 under IRS Notice 2567, plus roughly 20% of net self-employment income as the employer, with total additions capped at $72,000. If you're 50 or older, there's another $8,000 in catch-up, and if you're between 60 and 63, it's $11,250 instead. An HSA is $4,400 self-only or $8,750 for a family, plus $1,000 more at 55 and up. And that one's deductible, grows tax-free, and comes out tax-free for medical costs, which is the only triple tax-free account in the code. This is the hill I'll die on. Most freelancers set up the solo 401k too late. You cannot make a 2026 employee deferral in a plan you open in 2027, and every year you wait, you're volunteering money to the Treasury. I help solo workers stop overpaying the IRS, and if I could fix one thing about how people sequence their first 3 freelance years, it'd be this. Open the plan before December 31st. Fund it later if cash is tight. How much you can actually put in depends entirely on your net profit and your filing status, so don't anchor on the headline $72,000. Almost nobody hits it. And then there's the deduction. You don't have to do anything to earn. The Qualified Business Income Deduction, Section 109A, knocks up to 20% off your qualified business income before tax. It survived. The One Big Beautiful Bill Act signed July 4th, 2025 made it permanent. On $80,000 of qualified business income, that's a $16,000 deduction, which at a 22% marginal rate is about $3,520 you keep. There are phase-outs once taxable income climbs, and they're stricter if you're in a specified service trade, consulting, law, health, financial services. So high earners in those fields need to look closely at where their taxable income lands. Also note what QBI doesn't touch. It reduces income tax, not self-employment tax. That's a separate 15.3% on 92.35% of your net earnings, and you deduct half of it above the line, which is a small mercy. One more thing on the mechanics, because deductions and quarterly taxes are the same conversation. Your quarterlies aren't a mystery. Take your expected net profit, subtract these deductions, apply your bracket plus 15.3%, divide by 4. That's the formula. Every dollar of legitimate deduction you find in August lowers the September 15th payment. And the safe harbor is your friend. Pay 100% of last year's total tax, or 110% if your adjusted gross income topped $150,000, and the IRS won't hit you with an underpayment penalty even if you owe more in April. Your exact safe harbor depends on last year's return, so pull it up rather than eyeballing it. Do this today, not in April. Open a separate business checking account so your Schedule C basically writes itself. Photograph receipts the day you get them, and put a recurring calendar reminder on December 1st that says open or fund the solo 401k. That one line has probably saved my viewers more money than everything else combined. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this cleared something up, subscribe. I put out one of these a week, aimed at people who never got the employer handbook. And if there's a freelance tax or retirement question you've been sitting on, leave it in the comments and I'll build a video around it. Next week, I'm putting the 2027 freelancer contribution limits side by side with 2026 so you can see exactly what moves before you plan your year.